Social Security is one of the most complex and confusing federal programs. With over 2,700 rules, it's no wonder that we're confused about when and how to start collecting and who to turn to for help. Welcome to Social Security Answers from the Experts, hosted by Martha Shedden. In this podcast series, Martha meets with professionals to provide you with the answers to questions about this most important financial decision. And now, here's your host, president and co-founder of the National Association of Registered Social Security Analysts, Martha Shedden.
Hi, everyone. Welcome. I'm Martha Shedden, and I am here today with Mark Hulbert. Mark is a seasoned financial expert with over 4 decades experience analyzing investments and market trends. Adept at translating complex investment concepts into easy to understand conclusions as a columnist, newsletter editor, frequent guest on TV and radio, and leader of investment seminars and workshops. Mark has written for the New York Times, USA Today, and for MarketWatch, among other outlets. So welcome to the podcast, Mark. Thank you very much for joining me.
Well, my pleasure, Martha. Thank you.
First of all, tell us how you came to work in finance and specifically not only analyze investments, but also write about them for these different publications.
Oh, absolutely. Yeah. So it was out of grad school. I graduated from graduate school in 1979. I attended one of these investment seminars, which used to be the major way in which people would hear about these investment newsletters. I mean, it's hard for us to imagine today in the internet world that you don't really need to actually physically show up at an investment conference to get exposed. But this was the granddaddy of the investment conference world. It was in October of 79. I think there were something like 10,000 investors there. And it was right at the height of the gold mania, you may recall. And people would line up between talks. There was a bank of payphones. People were lining up 10 deep to call their broker and make trades. And so the level of energy and excitement was great. And I had the reaction, which I think almost everyone else did, is that these advisors who were telling people to go buy this or sell that couldn't all be right, because they were contradicting each other. But they all would claim that if you'd only been smart enough to follow them over the previous year, you would all be rich. And so the reaction, which I think is a very normal one, is wouldn't it be good to have a service that would keep track of their performance and hold their feet to the fire? And so that's what I did. It's in concept no more difficult or complex than that. I simply did what they told me to do. So I set up, this was very early of the computer age, but I was able to set up a simulation of the trading environment on my computer. And I got data feeds from all the exchanges and set up portfolios according to what these newsletters were telling the clients to do. And then I just traded those portfolios. I used prices that prevailed on the day that an anonymous subscriber would be able to actually act on the advice rather than use the price that prevailed when the editor said that he or she first thought about it. And so I was realistic from that point of view, and I took bid-ask spreads into account. I charged discount brokerage commissions. So I let the chips fall where they may. And so that's what I started doing. My first issue of the newsletter was in the summer of 1980. And so I've been doing this in one form or another now for, golly, I'm in my starting my 42nd year this month. I was tracking up until 2016 about 200 separate newsletters that had between them about 600 model portfolios. Over the years, I won't go into the details, but the newsletter had been acquired eventually by Dow Jones. And Dow Jones decided they didn't want to continue to be in the newsletter tracking business. So they shut down my tracking operation, but they still wanted me to continue writing for them. And so for the last 5 years, I've devoted basically 100% of my energy to writing about the investment themes that basically I learned about in the prior 35 years. So that's what I've been doing. And that's answer your question of how I got to writing about this.
Yeah, so you weren't really writing about it that much, except for the newsletters until the last 5 years. Is that correct?
Well, no, that's not entirely the case, though. That I can see how that question would come up from what I said. So I first started writing columns in 1986, believe it or not. And that was for Forbes magazine. I wrote for them for a little over a decade. And then I wrote for the New York Times. And then in 2002, CBS Market Watch bought my newsletter. So I started writing for them. And they in turn got purchased by Dow Jones in 2005. And so I've been writing for the Wall Street Journal and Barron's in addition to Market Watch ever since.
Wow. Well, you certainly have a lot of experience that you can share with us. Without getting too bogged down in too much detail, what investment trends are you seeing for soon to be retirees or those who have retired in our audience that they should be aware of? Is there anything that may surprise us out there?
Well, that's such the $64,000 question, isn't it? And I guess there are two major themes I would stress in response to that question. One is the future is far more unknowable than any of us know. And I think that's such, in one sense, a trite conclusion, but it's something that we may acknowledge sort of in passing and then continue on with our lives as though the investment world is more predictable than it really is. And I would say, looking back over the 40 plus years I've been doing this, that it really is far more unpredictable than any one of us could imagine. And I think we need to take that into account. It translates into a great dose of humility in terms of predicting where the markets are going and building a very large buffer or margin of error into any of our retirement plans, because we're planning for now much longer retirements than ever before. And where the markets will go over the next 20, 30 plus years have a huge impact on our retirement standard of living. So lesson number one, I think, is just, step back whenever you think you know what the market will do in the future. So that's lesson one. And secondly, which related to it, is that insofar as there are any regularities in the world, the markets over the next 20 or 30 years are almost certainly going to produce a lower rate of return than we've seen over the last 20 or 30 years. That's a big adjustment that we have to take into account. I mean, for example, there are many target date funds that retirees have in their portfolio, or just in general, any of the financial planning assumptions that we'll make based on history are fraught with peril because they're based on one of the most extraordinary periods in US market history. I mean, 30, 40 years ago, in fact, it was in 1981 that interest rates were, the 10-year yield was what, 16% plus?
Yeah, I remember that.
And it comes down to what now? Well, at one point it was below, last year it was down below 1%. And that's an extraordinary period for bonds. Well, even if interest rates aren't going to go back to 16%, and of course, lesson number one is we have no idea, but I don't think it's likely it's going to go back to 16%. But even if it stays constant at 1% for the next 20 or 30 years, bonds will only produce a total return equal to its initial equal to their initial yield, which is to say 1%. So the extraordinary bull market in bonds over the last 40 years, we can guarantee almost, again, I need to have my own dose of humility and say,
yeah.
You never predict anything for sure, but I'd say it's almost guaranteed we're not going to see that kind of return. And the same way with the stock market. Who knows whether valuations will go even higher, but right now, PE ratios, or the Schiller PE, which is a different way of looking at the relationship between price and earnings, are all at well above, not just above average, but well above average levels. And if you go back in history, it's unlikely that the market's going to produce huge returns in the wake of those kind of valuations. In order for us to have similar returns for stocks for the next 20 or 30 years as we've seen for the last 20 or 30 years, valuations would have to go up beyond, not just a little bit, way beyond anything that's ever been seen in US history, which isn't to say it couldn't happen, but I think that requires a huge leap of faith. And so I think we need to put into our financial plans the assumption that we're going to have lower returns going forward.
Better to be conservative. about
Well,
it.
that's right. I mean, indeed, economists will tell you, this is nothing particularly original on my part, but interest rates reflect growth opportunities in the economy, and lower interest rates mean that there's less growth potential in the economy. And those reduced growth prospects have to translate throughout the financial markets. I don't see any other way around it.
Yeah. Recently, you wrote an article for MarketWatch about the current retirement crisis isn't easy to pin down because, and you said, and I'll quote this, the paradoxical situation exists because of how we try to assess the state of retirement finances. We all too often focus on the average retiree, even though this hypothetical average individual doesn't exist. Financial preparation for retirement varies so widely that this average creates more confusion than insight. So I can see how that's probably true. Then the question is, if someone can't rely on the averages to make personal decisions, what concrete steps can they take to weed out this confusion for their own choices?
Right. Well, that's a great question. And again, because there's such wide variety, I don't think there'll be one answer to the question.
That's
But so, for example, if you look at the Vanguard every year has a wonderful publication called How America Saves, and it has an enormous amount of data. And last I looked, I think the average 401k balance was just over $100,000, right? So then people will say, okay, well, if you have a 401k balance of that amount and you make various assumptions about the markets, this is how much you'll have to work with. But it turns out that there's incredible variation around that average. The median 401k balance at Vanguard, as opposed to the average, is a lot lower, which is to say that you have a very few people with incredibly large 401ks and lots of people with very little. In fact, last I looked, I believe the amount of 401ks at Vanguard below $10,000 was something, it was in the order of 20 to 30%. It was like a quarter or more of their universe, which is, again, that's just at Vanguard. And some people have 401ks at Fidelity and Vanguard in a number of different locales. But on the other hand, Vanguard's database is like 4 or 5 million retirees or potential retirees with 401ks. So it's going to be relatively representative. So the advice one would give to somebody with a 401k of $10,000 is going to be far different, as you can imagine, than to somebody who has a 401k of $1 million or more. And that's where I think, again, and I'm guilty of this, I love statistics, and so I'm always focusing on numbers, but you can look at the average and miss all of the really important detail that make all the difference. I mean, I used an analogy in that column that you referred to, is it's the man who has his feet in the freezer and his head in the oven, and on average feels just fine. And I think that's what's going to be what we have to remember. Another example of how one would approach this is to look at how important Social Security is for people with those small 401ks. In fact, I don't have the percentage right off the top of my head, but it's a substantial percentage of retirees for whom 90% or more of the retirement income comes from Social Security.
Right.
So I could write a column for retirement finance that looks at all these investment trends and what the future may be like. That's all well and good. But for all of those, I mean, again, it's a substantial percentage of retirees for whom the investment world's prospects will have no difference, no effect on their retirement standard of living.
Yes, and that's so true. So that ties in with my next question, because you gave some statistics about retirees. 35% think they are prepared. Only 35% think they're prepared. 1 in 4 are worried they outlived their money. I've heard all these statistics. 59% retire earlier than they planned. Many of those are because of health issues, and 16% work part-time. So what are people doing wrong when they handle their Social Security decisions and retirement funds that they still have to work part-time? And what are some decisions they can make that help them not be in that 16%?
Right, fair enough. I mean, and I'm getting into your wheelhouse where you know a lot more about some of these things than I do. But for what I know is that almost universally, if you can wait as long as possible before declaring Social Security, that's not a bad thing to do. And in fact, you get a guaranteed return of 8%. And I can tell you that I don't think there's any chance that over the next 10 years or whatever period of time you choose, that the markets with, let's say, a 60-40 or some diversified portfolio are going to produce a guaranteed return of 8% above inflation, really. So that's an incredible return and it's guaranteed. So I think anything you can do to avoid that is a good thing. So you mentioned working part-time. Is the longer you keep working, that allows you to postpone the declaration of when you have to start taking Social Security. You mentioned, health reasons being one of the reasons why some people have to declare earlier. And that's one of the heartbreaks of those health issues is that there's little you can do if you have them. Though I was reading there's a great resource. The Boston College has a Center for Retirement Research, and they have a number of fascinating papers. One they just posted this summer, which is interesting, was out of the Netherlands, where they noted that people who work longer tend to be healthier. And the question is, what direction does that causality go? Is it that people who are less healthy have to retire early? That makes sense. But what if it's the other way around? And they were able to exploit some very interesting statistical properties. There was a change in the tax law as well as some of the retirement benefits laws in the Netherlands that you're able to measure this. And they found that when you do work longer, you actually have better health outcomes. So I'd say, it's not going to be a panacea if you have some terrible illness. I don't want to be a Pollyanna about this, but nonetheless, that's another reason why you may want to work longer. There's another study that I wrote a column about a couple of years ago, and the citation I will not get, so I won't even try to mangle it. But a professor at one of the Ivy Leagues looked at. There was a change, as you know better than I, but back in the late 50s, they made the change to allow for early declaration of Social Security benefits. So that provided one of these events that allows statisticians to see what effect that one change had. And it turns out that it happened among men, interestingly enough, not women, but men, the first year that went into effect, who declared at 62 had a higher mortality rate. And not just a little bit, it was significant. And what the author, the economist, believes was going on is that you lose your purpose in life somewhat, and perhaps then you encourage unhealthy behaviors. You maybe eat, you sit on the sofa, watch TV, you may smoke more than you should. I don't know what it is. You can speculate a number of possibilities of some lifestyle issues, but that would point in the same direction. So, and these go way beyond investments. So this is not my wheelhouse at all to talk about behavioral aspects, but I think it points in the same direction.
Oh, and I completely agree. I think a lot of people I see claim Social Security early, or they quote retire at 55, and then they find that really, what are they going to do? So luckily there's some strategies for Social Security that they can change their mind, but it's astonishing that because that availability to claim early at 62, like you said, is there, the vast majority of retirees do. I think that's changing though, which is a good thing. So I think people are getting the idea that they should wait if possible.
Yeah, it's interesting, so this feeds into sort of tangentially the whole FIRE movement, so the idea if you're going to retire early. And MarketWatch has been running a number of columns of sort of autobiographical reflections of people who, first of all, it's rare to get so much money by age 40 that you can really retire for the rest of your life anyway. But among those few who have, I'd say the majority of the articles I've read, a skeptic could say, well, the editor chose it to prove a point. I don't know whether that is the case at all. I'm just wondering. But nonetheless, the majority of the articles from these people said that they were bored out of their mind and they didn't know what to do. And they went back. They may have picked a different job, and that's good, and may have found a new chapter in their life, and that's good. But the idea that somehow we're going to lie on a beach for the next 40 or 50 years is, it's good for a month or two. And then what are you going to do?
Yeah. Well, that's so funny because my son is very much that way. He's in his mid 30s, but he's not going to quit working. I think the appeal is the ability to be flexible and be able to do what you want to do, which is okay if you have hobbies and different things to do. And
then that gives you the flexibility. If you need to work longer, you can, and you're not as reliant on an early claiming of Social Security. Yeah.
Right. What do you feel the Fed is making things better or worse for retirees with the 2020 CARES Act?
Oh, well, boy, that's a complicated question, isn't it?
You have a short opinion on that?
Well, I think the answer is both. Of course, talk about going out on a limb, right? But I think, and this is where somehow our political debate has become so polarized that we can't even admit that. I think it doesn't matter whether a Democrat or Republican had been in office, they would have done the same thing. I mean, if you look back in the financial crisis, we threw what at the time seemed like an unprecedented amount of money at the economy and probably turned it around. And it looks like we did the same thing in 2020, but it was entirely different political parties that were in power. And the best analogy I can think of, my wife's a clinical psychologist, and she says that one of the greatest predictors of whether people will have a panic attack is whether they've had a prior panic attack. And so what that means clinically, she tells me, is that you need to avoid at all costs your client having a panic attack, including, she's not a big fan of drugs, but including something anti-anxiety medication that keeps people from having that panic attack. Because once they've had that first one, then it's much harder to treat over time. And it seems like, using that very clumsy analogy, I mean, the economy was in, already beginning of stages, but a real full-on panic attack. And it is hard to put the pieces back together when you completely, everything falls apart. And so at that point, it's better to do anything, including a very inefficient way of doing it. Throwing money at something is probably not the most efficient way of overcoming it. But if it keeps you from having that full-on panic attack, it might be better off than nothing. And so I think the perfect's the enemy of the good. In retrospect, we have many, many criticisms, everyone, I say we, but I mean, I'm one of them, but of how some of those pieces of legislation were put into effect. I think there was probably a lot more fraud than there should have been, and there could have been more safeguards, but we didn't have unlimited time to figure that out. And so in that sense, I think it's more good than bad. I think all of us in the same position as the monetary and fiscal authorities in Washington would have done the same thing. Now, whether you do the same thing now that we're off we're away from that panic attack, I think there are some better and worse ways in which one can incentivize a return to a productive economy. But that's a much broader discussion.
But that was such a uniquely historical situation we just went through.
Isn't it though? Yeah.
So, I'm surprised we came out of it as well as we did, really.
Well, that's right. We did come out of it extraordinarily well. I mean, to think about, back in the dark days of March of last year, to think that the market would more or less double over the next 18 months is just extraordinary.
Crazy.
And I think that worries me, because that's an extraordinary return. And I think it's a reflection of perhaps a lot of that easy money that was just flooded in the system has propelled security prices upward. And well, I mean, there's no doubt that that's a lot of where that money is found, that weighs into assets. But that sort of, you're robbing Peter to pay Paul. You're reducing the future return of those assets if you're propping up their price with funding money, because they're now that much further ahead of their underlying fundamentals. I mean, earnings are going to have a hard time supporting current prices. And of course, we know interest rates and bonds are having a hard time they'd have a hard time supporting a very robust return. The inflation adjusted, the real return of bonds is almost certainly negative, which is extraordinary. And that's a huge piece of retirees' financial plan. And here it is, guaranteed to lose money to inflation. We're really in unprecedented waters.
And I saw personally with the use of the Social Security optimization software that we use, and it's developed by an economist, and to have those changes in inflation rate and rate of return, like just like that. They look at them every 6 months, but there was a time when it just happened in a couple of days, and we were scurrying around because that gives all kinds of different problems for the training that we give. But it was a crazy time. I'm really interested to know how you came to be, because you get questions about Social Security, right? Where's that come from?
Well, that's a good question. So I think maybe part of it is just biographical. As I'm 65, and so I think people look to me more for that. But more specifically, one of the opportunities that opened up at MarketWatch was writing for a newsletter called Retirement Weekly. And the column that I replaced, who was writing that column before, was Robert Powell, who, a giant in the field. And so I'm struggling to fill his shoes. And so I'm reminded over and over again that the wise man is he who knows nothing. And so it is so true, and Social Security is by far no exception to this, that the number of variables, as you know, and your programmer knows, in trying to come up with that optimizer software is extraordinary. And the moment you might feel tempted to say this is always the case, you'll discover that it's not always the case. And so I'm glad that people like you and your organization exists, because it's so useful for people, because the idea that they can learn this on their own is almost impossible.
It is. I think the learning just goes on and on. I mean, I can't imagine. I learn new things every week or every day, and every case that I have. I mean, the strangest twists and turns and exceptions. It's fascinating to me, but it's pretty overwhelming. Like you said, people don't even know what they don't know, and they don't know what questions to ask either.
Well, that's right. It's so true. And this is where back to my general theme of humility, is that, Social Security in the grand scheme of things is a relatively predictable thing, right?
Relatively.
And yet, trying to figure out what the optimal solution is for when to start claiming Social Security is itself incredibly complicated. Well, if you think about it, that being near the end of the spectrum of relatively predictable, what about the markets themselves, which are at the other end? And so, my general advice to clients is that, in fact, my column earlier this summer was about, that we need to focus on some of the more meaningful issues about what will make the difference to our retirement satisfaction.
Yeah.
And I quoted a study from EBRI, the Employee Benefits Research Institute, and they had broken down retirees into 5 cohorts according to how many assets they had in retirement. And the bottom cohort, the ones that had the fewest assets and income, reported average satisfaction levels with their retirement that were much lower. But interestingly, the other 4 were almost the same, which is to say that once you're out of that really, the worst 20%, give or take, right?
Yeah.
So as long as you've jumped over some low hurdle, additional money doesn't buy you happiness. Now, we always know that is in large part true, but it's amazing how low the hurdle is. The description of the criteria to make it into that bottom cohort are really low. And yet,
interesting,
getting out of that is important. That's one of the recommendations I make is, insofar as you can supplement Social Security with an annuity and provide that kind of guarantee, that creates such calming effects on the anxiety
Oh.
you'd otherwise have.
I've found that with my clients, just knowing what their Social Security claiming decision will be and what annual amount that will result in, not the total over their lifetime, but the annual amount. And they just have such a sense of relief. And, they thought it was going to be so much worse. So it's wonderful to help them with that. Let's see, if based on your experience and knowledge, what are the top 2 or 3 most important takeaways that individuals approaching retirement and about claiming Social Security that they could learn from you?
Well, I would say that the first one, which builds right on what we were saying, is you need to engage a qualified expert to help you on that Social Security decision. You hear the saying all along, lots of fields, don't try this at home alone. And I'd say that's probably the case, even though I write for a newsletter that presumably helps people decide how much they, or when and how much they should respond to some of these questions. In the end, I always recommend consult with somebody who is studied this, such as you and your organization, because as we were saying earlier, it's almost certain that you don't know everything you need to know.
Yeah.
So that's lesson number one. But insofar as you can supplement your income rather than ask for Social Security earlier, I think that's probably one of the more, even though I don't want to claim certainty on anything, that's probably a good rule of thumb. And one thing that I think is so wonderful about Social Security is that it is a guaranteed income. It will last as long as you live. And if you look at surveys of retirees, their number one worry, at least in the surveys I saw, was outliving their money.
Oh, yes.
And so providing some anxiety relief on that score through an annuity is not a bad idea. Now, unfortunately, annuity rates are a function of where interest rates are. So annuity payout rates are not great right now. And you can't get a Social Security, an annuity payout rate that's indexed to inflation. And so there are a number of problems with it. And I would say for every piece of advice I give to make sure you talk to an expert about Social Security, I double that or triple that when it comes to annuities, because the fees are sometimes exorbitant and they're complicated and it's hard to compare. But again, the idea of, if your top anxiety is outliving your money, reduce that anxiety. And even if you're giving up, with an annuity, you're giving up the possibility of, making a killing in the next Tesla or the next whatever GameStop stock. But in return, you're not losing sleep at night over losing so much in your portfolio and outliving your money. And again, especially given that EBRI survey results showing that happiness or satisfaction with your retirement is so, it's uncorrelated really with the amount of assets and income you have. I'd say we just need to, I guess this is my other lesson, just don't forget what's really important. You might think dying too early would be a bigger worry, right? But if you're worried about running out of your money, you have a greater worry of living too long, which is so ironic that we've come to this. And so, I just think people need to remember what's important.
Yes, it couldn't say it better. Wrapping up here, is there anything that you've learned or discovered or experienced that would surprise people?
Oh my gosh. Well,
it can be about work, but about anything. My last guest was a mountaineer, so he shared about that.
Well, I don't know how much it might surprise people, but it gets back to this question of how unknowable the future is. And, that can veer off in semi-spiritual directions, right? We just have to trust in the future, not because the future always works out. So I'm not talking about a blind faith. There's a room for that, I think, in some parts of our lives too. But in this case, we can't control it anyway. So I'm trying to think of a good analogy. I mean, like with my daughter who has high anxiety about college, I'll try to remind her she can't control everything, right? And it's the same thing I tell retirees: we can't control everything. And in fact, we can control very little. And the things that we can control have to do with more how we live our lives. We definitely can't control the markets. And so I think there's a certain release and surrender that comes, not because you're giving up, but because you're recognizing we can't control everything. And so the problem, I'd say, that goes with it, the other side of the coin, is a lot of retirees spend an enormous amount of time investing in the markets or trying to play the markets. And it may be that that's because it's fun and intellectually challenging and they otherwise don't have anything to do. And I say, all power to you if you want to do that. But don't kid yourself that that's the way to retirement riches. I mean, it's possible that you'll win the lottery too. But another column I wrote earlier, I'm going way off on a tangent here, but another column I wrote earlier was that how average 401k balances at Vanguard have grown over the last decade. And it turns out it's almost a one-to-one correspondence with how the markets have done. And so, you have people who are playing the market on a day-to-day basis. You have people who are buy and hold. Doesn't matter. The correlation with the markets is overwhelming. And if the markets are not as robust a performer over the next 10 or 20 years, which I think my own bet is that they will be a lot less than we've seen over the last 20 years, then it doesn't matter what you do. You're not going to be able to control that, but that was going to greatly affect your returns. One solution to that, again, suggested by my wife, the clinical psychologist, is to divide your portfolio up into what's sometimes referred to as a permanent portfolio and a variable portfolio. This is following the distinction that was made by Harry Brown, who was a newsletter editor I followed in the 80s and 90s. But he recognized that most of the time when we play around with our money, we make things worse. So what you do is you take the bulk of your money and put it in whatever your retirement plan you and your financial planner have worked out. Don't touch it. Then you have your play money. Go to town with your play money, but recognize that the odds are overwhelming that you're going to be worse off, but you aren't making your retirement standard of living vulnerable to making a big mistake. And so, just recognize what you're in it for. I mean, you would never claim you're going to go invest everything in a lottery and call it your retirement financial plan, right? But a lot of people are engaged in the markets in a very gambling fashion. And I'm afraid they're going to find that at some point the markets catch up with them.
Yeah. And it's really how we react to the circumstances as we move forward into retirement too. It's things are going to happen. They're going to be difficult. Some are going to be wonderful, but you've mentioned many times about the panic and anxiety, and it's really how do you react to those circumstances?
Well, that's right. I mean, retirement, I think we can look at it as a wonderful time in our lives, and it is. And it teaches us, or we learn in the process, just what you said, is that we learn to accept what comes along and make the most of it. So what we can control is our response. We can't control the world, but we can control our response. Anyway, this gets far into my wife's my wife's expertise rather than in finance. But I think the intersection of psychology and behavioral economics and the markets is a huge intersection there.
And you have all of that covered as a couple. That's wonderful.
There you go.
So I think we need to conclude here. Where can people go to follow you or find out more about your work, get in touch with you?
Well, I'd say the major, I write for a number of different publications, but 90% of them or so are on MarketWatch. So if you just go to marketwatch.com and search on my name, you'll bring up all the columns that I've written. And my email is available at the bottom of every column. So that may be the easiest way, just to go to the column and click on my email at the bottom and ask me any question. I'd be happy to see if I have anything to offer.
Okay. Well, thank you so much for being on the podcast. This has been really wonderful.
Well, my pleasure. Thanks. It was a fun conversation.
Thanks, Mark.